Welcome to the Property Couch, where each week you get to listen to two of Australia's leading experts. Bryce Holdaway, co-host of Location Australia on Foxtel's Lifestyle channel, co-host of Escape from the City on the ABC, and partner of Empower Wealth Advisory. Ben Kingsley, chair of Property Investors Council of Australia and the founder of Empower Wealth Advisory, named the 2018 and 2019 Property Advisory Firm of the Year. Stay tuned as they bring you the insider's guide to property, finance and money management.
All right, folks, welcome back to the Property Couch. G'day, mate. How are you?
G'day, mate. I'm going all right. Thanks for asking.
That's good. Good to hear. Hey, have you done your research this week? Have you been looking at the AFL ladder? Have you seen where we are this week?
Yes, mate. Congratulations. Now that you've got an ex-Collingwood coach, you seem to be doing better. So, all good. Well done.
Well, I've said this before, but clearly our trajectory's gone up. Yours has gone down since that particular coach left. So clearly...
You took a couple of extras with you as well. There's a couple of other coaches who joined the year after. But anyway, no, mate, all credit to you. You're
second on the ladder, but only third favourite for the flag, and I reckon that's fair enough. I actually think third favourite for the flag is generous.
Takes the pressure off.
I reckon it's generous. I
think we play each other in a couple of weeks, don't we? Is that right?
Yeah, that'll be fun.
Yeah, it'll be good. Not very often that Freo are on top of the pile.
Here we go. Now he's digging the boot in. So, hey, Ben, you and Julia recently had a little chinwag together. It was a bonus episode.
We have two little chinwags. We've got one that hit the airwaves on Tuesday. The first bone episode, and we've got another one hitting next Tuesday.
And it's very purposeful because we are now in the shadows of the tax season, Ben. Mm-hmm. And clearly we need people to start thinking about tax season, start thinking about last opportunities to, at a bigger level, to do everything you can to minimise legally your taxation, Ben.
Get all that in order. Yep.
But at a property level, we want to shout out to everyone that there's some information that you need to listen to with those episodes because they are crucial for your tax return this year. So,
and even some of the more basic stuff. We do a deep dive, Bryce, into car expenses and all of that. So all of that's coming. We've got a few little other things. So what I love about that is there's so many nuances in tax. But being able to take a deep dive with Julia, who's obviously a subject matter expert, means that we can unpack all those nuances because there's a lot of general statements around taxation which don't necessarily ring true under every circumstance. So, so a couple of episodes coming up for.
And noticing, Ben, that you're in the hosting seat with Julia. So does that mean I can kick back now and just do what you do and put the gloves on each week? And
for the record, and she probably obviously the Stig won't say anything, right? But I actually gave you a compliment when I was recording with Julia to sort of say, I'm no good at this hosting stuff. We need to get Bryce in. You
gave me a compliment, Ben. Gee whiz, after 390 episodes, you're going to admit that. Wow.
We all know the star of the show is you, mate. So that's all good. Yeah.
No, well, clearly that's you, but I just keep it all together. I just make sure we swim between the flags each week.
That is so not true. Absolutely so not true.
But well done for doing that stuff with Julia, because I think it's really important content for our community. So it's all part of our mission here on the couch to continually be adding value. So folks, if you are listening to this one, you haven't listened to that one that we put out on Tuesday, go and have a listen. Keep your ear out for next week's as well. That'll be on Tuesday as well, Ben.
And hopefully another special guest next week as well. So everything sort of, we've got some fun stuff happening at the moment on the couch.
Yeah, no, we always got stuff, and we've got some awesome guests coming up too. So stay tuned for that. Hey, a couple of things. We're always giving out resources. I've done this shout out before, Ben, where I want to really encourage. I know that people, this will sound really dumb, but people who listen to podcasts like podcasts, people who like reading blogs like reading blogs, people who like watching YouTube like watching YouTube. So that being the case, that people who are listening to us now may not want to swap over, but there are resources aplenty on our YouTube channel. For both the Property Couch and Empower Wealth. There's plenty of free videos there. So if you're on your smartphone, go over to YouTube and subscribe to those two channels. And then go over to the socials, Ben, where we're not just putting up pretty pictures. We are actually turning little snippets of what we talk about with our guests and Stiggy and the team turn them into wonderful little TPC Gold videos that you can get little bite-size takeaways from that as well. And each week we, now for the last 6 years, Ben, we've been sending out a notification each week with all of the resources to everyone and saying go to the show notes. We've done a little tweak. Stiggy and the team have done a little tweak that in that weekly update, we not only do a summary of each episode, so you can quickly do a quick check of everything that we talk about, so you can just do the summary view, so you know where to dial in. But also we now put in categorically what all the free resources are we mentioned. So it makes it super simple. So go to our website, thepropertycouch.com.au. On the homepage, you can't miss it. First thing you see above the fold, you can download our free book, Ben. And as a result of downloading that free book, we will update you each and every week. Or at the end of every episode, you hear this boring voiceover that I've recorded, Ben, that says, hey, listen, if you want to fast track the catch up of all of the last 390 episodes, but there's the first 20 that you really need to be dialed into, there is a binge guide. And it's thepropertycouch.com.au/fast track. And if you go there, there's a whole bunch of things that you can get up to speed very quickly if you're new to our community. But again, you'll give us your email address, and then each week we will send you all of the free resources.
So what you're telling me now, Bryce, is one email address to us, you get everything.
Yep.
Is basically what you're telling me.
Yep. All the free resources that we can possibly put in front of you.
Fantastic. And if you're not getting that weekly email from the team, can you reach out to us another way? Because email delivery could be blocked or something like that. So if you've ever downloaded something from us in the past and you're not getting it, and you're not getting the free weekly for a weekly update, then let us know and we'll make sure you get it, because one email basically taking all the friction out, you start to get all the content.
Yeah, good point. Go and check your junk mail. Hopefully we're not there, but who knows, Ben? We might end up in the junk mail. And Ben, while we're in this mood to give stuff away, one of the things that we've got a relationship with our publisher, we say, hey, look, can we take a little side note of books and put them in our office? And if anyone wants a copy, we'll give it out for free. So the way we do that is if you pay for the postage, $9.95 postage, Ben, we will give you a copy of the book for free, normally $29.95. So if you go to the
Guide to Property Investing, got it.
Armchair Guide. So if you go to the armchairguide.com.au, Ben.au, also AU, you can go in there, leave your deets, and you can get a free book. Now, if you like listening to it on audiobook, there is an opportunity there for you to get access to the audiobook if that's your jam as well. So there you go, folks. We're trying to give as much resources as we can to help you on your lifestyle design journey, but not wealth creation. Everyone talks about wealth creation. We talk about lifestyle design here.
Yep.
Because that is what it is all about.
Love it.
Your lifestyle design. Hey, we're going to talk about today the topic, which is making news, newspapers, morning breakfast, afternoon talkback radio, everywhere, Ben. It is all around.
It's not going to slow up, Bryce. It is not going to slow up for the next 6 months. So yes, good topic to be talking about.
So last week we had Evan on, which was phenomenal. We got some really great feedback. Is he not a great guest to talk to? Just the way his mind works was phenomenal. I really enjoyed that conversation. So lots of feedback about that in the bigger picture around the economy. Today we want to talk about that impact towards property and what that looks like and what we're thinking and our thoughts around that. So hopefully that's going to add some value to the community as well. But I wanted to riff with you today, Ben, on our mindset, my mindset minute. But I want to engage with you on this because it's something that I've been thinking about. And when I was younger, I used to sit in lots of audiences, as I know you did, right? And we would go and try and learn our craft early days. And what's happened is over time, we've now been fortunate enough that we are now in a position where we get to be in a privileged position where we get to have a platform that speaks to a community that says, this is how we believe you can climb the mountain of lifestyle design. And if it resonates with you, come on board, have a listen and implement what we talk about. But there was once a time when we were looking at the people on stage going, what are they talking about? And is this what we need to do? So there was once a time when I was always thinking, it probably has to be a bit more complicated than this. It can't be just what they're saying. But now that we are on the other side, I've got this framed in my mind. I was talking to you about this earlier. I want to riff it on behalf of our audience. But advanced people always do the basics. Let that land. Advanced people always do the basics. And so the meaning of that is when you've got most people who are casting stones and saying it has to be more complicated than that, and they're saying the market will fall apart and now's not the right time, and if you put your ladder on the right wall, and they're not even doing it. They're not acting on it. They're actually casting stones without having the experience. A friend of mine used to say, a man with an experience, and that's a human, a man with an experience is never at the mercy of a man with a theory, right? So it's the people who are actually in the arena doing stuff. So all success requires is scale. So let's break that down. All you need to do is all the things that you did for the first property, as well as you did it before, and I put a little caveat on that, plus any natural growth that you get from expanding your mind and being around the right people. But just do what you did the first time, as long as you did it right. And then just do more of it. So scale it to 2, then 3. And if you're lucky, stop at 3. But for some people, they need 4 or 5 properties, right? But then that's what makes you advanced, not complexity, it's scale. And so I really want people to let that land, because you're listening to this, you're hearing us, we've built our portfolios, but now we're on the other side of it. All we did is the basics, and we continued to do the basics. And then we just did a rinse and repeat scaling exercise. And that is how you see these people who are successful doing it, Ben. So thoughts?
And I think it's really clear and sensible advice, Bryce. It's just basically saying that get the knowledge at a level that gets you to an informed position, and then act on it. And so in property investing, it's relatively simple, because the things you need to understand aren't too complex. You need to understand that people need shelter. You need to understand that land's in limited supply. You need to understand that people need to have jobs and an economy to work around to be able to continue to keep affording that area. And you need to see all of those fundamentals play along. And as you say, when you get confident in executing on one, you don't have to bring in fancy execution. You don't have to be aggressive or greedy. Just rinse and repeat on several of those. And I think as you build up your wealth, and as you say, we're in a privileged position where we can, look past the last 25 years of us doing this. We can find those moments when we did the fundamentals well, and we executed on those, and the proof is in the pudding in terms of where we sit today.
It's not complexity, folks. It's scale. It's not complexity. It's scale. So the advanced people always do the basics, and that's what I want to talk about today. Because we are talking about, I hinted at it before, Ben, but there is jitters in the marketplace. You talk to local agents, and they are seeing their opens less people. People are jittery. So clearly, there's this resonance around that is uncertain for a lot of people, right? But for this is what I want to say to all the property couches, Ben, the people who have been devotees of what our movement for some time. This is where you've invested in yourself. So this is where you get to be, not just Ben and Bryce. This is where our couches get to become the steady voice of reason here. They get to apply a lot of what we've been talking about, and don't get caught up in a lot of the hysteria that happens. Understand that headlines are just designed to grab attention, and they are going to always grab the most attention when there's a little bit of jitters around. So it's really important that we're just in the shadow like this. What we're experiencing in the last week, Ben, is nothing compared to that first week when the pandemic kicked off. Like that was uncertain, like on such a scale that everyone should be in the shadow of that, going, I've been here before, I've done this. I've got to exercise a bit of calm here and just go back to the fundamentals that are really, really important. So I think one of the things that we want to talk about today, and I'll invite your comments to this or separate to it, Ben, but we want to talk about some first principles around reminding our property couch community about how do you get yourself through some of these anxious times.
There's a lot to understand. So I want to start with just a comment that should be the foundation of your thinking whether you see the property market doing worse or doing better. And that is if we're talking about a severe correction, these things have to happen. So the thesis has to be this: it has to be forced selling en masse in concentrated areas to see a material correction. And by material correction, we would be talking 20% or more. You would need to be able to replicate that. So what you're going to hear is people who are advocating for significant double-digit falls are trying to prosecute an argument around forced selling in concentrated areas. So what we also want to do, and I think this is testament to the work that you and I do, Bryce, and that is that when the market had been booming for the last 18 to 24 months, we had been quite reasonable and mature. We weren't hyping it up. We just said all the fundamentals pointed to a strong price growth story, right? And we don't like those, fast growing areas, because it's unsustainable. What we prefer is moderate and sensible price growth over a long period of time, but it's not how the economy works. You get people who have FOMO, fear of missing out. And so people, get ahead of themselves. And so that's where a lot of people can argue or prosecute the story that we may be in a bubble. And so what we're going to talk about today, sensibly, maturely, the same thing in terms of keeping it calm. We're going to put some thesis in front of you and some considerations around why we do feel that it won't be a property crashes, highly unlikely, right? What it will be is more of a softer landing if you're talking generally speaking, but we're also going to be talking about where the opportunity lives. And when Bryce and I did our first property update in late February, we did talk about that this year was a little different in terms of the macro signals weren't as clear as what they were 2 years ago in terms of inflation, supply chain shortages, and those unknown unknowns, in terms of known unknowns. And so that's why we were like, our total conclusion at that point is we still see growth. We see interest rates rising the second half of the year. And one thing was absolutely for certain, that rental yields were going to go up on the back of very, very low vacancy rates, only getting lower. And potentially if interest rates were to increase, landlords are going to have to pass on some of those increases. So that was a given. That was a lock. That was always going to be our, number one point. But let's talk, Bryce, around some of the themes that we want to debate, because when others are debating on the other side, we do want to ask them, where's your evidence? Where's your proof in the data that this is going to materialize?
Yeah, it's a good point, Ben. So we're gonna run through our reasons why a property crash is unlikely. We're of the view of a softer landing story. So, but it's a couple of first principles that we want to set this discussion up, right? That we want to remind our catchers, because I said, look, we need to be the steady voice. So here's some principles for you to be the steady voice when you're having your conversations with your colleagues, your friends, your family during the week and on the weekends. Number one, we've said this right from day one, Ben, and we will say it right until we continue to record this podcast. Generalized commentary helps no one. So think about that. When you see a headline that says property is going to drop 30%, 25%, let's be conservative. Someone says it's going to drop 15%. The first question you need to say to yourself is, okay, where? Is that every property? Or is that just properties in the west of Sydney and not the south of Adelaide? Or is that only Perth, but nothing on the Eastern Standard timeline? Or is that only mean for houses, but townhouses are fine? Or are we only talking about, I mean, we could go through a million of those what ifs, but the point is very, very clear that we are not one big market. We are markets within markets. And so therefore, how is it possible that generalized commentary at the headline level on a national television show that's being broadcast into a house in the eastern suburbs of Sydney, the western suburbs of Brisbane, and 2 hours later in every suburb of Perth, how is it that that story can speak to everyone across the market? It can't. So we need to be able to be very clear that generalized commentary is all that they can give, but it doesn't help anyone because there is markets within markets. The second one for me, Ben, is residential property, we talked about it with Evan last week. He said it one way, I sort of concluded another way. Residential property is the only investment market in the world not dominated by investors. It is a tangible asset that has utility far beyond the financial return. And for a lot of people, the utility is more important than the financial return. Now, on this podcast, we're always talking about the financial return associated with bricks and mortar. But for some people that do not give a rip, I've got a mate around the corner who does not want his house to go up, is not interested in the story that I have around property. Not all he wants to know is that his house is paid off, and the fact that it's going up in value is highly irritating and annoying to him because it means his rates are going up. So, it isn't for everyone. They don't care about it continuing to go. So it is not dominated by investors, and so therefore people will buckle down. They will eat honky nuts and tomato sauce before they take the easy way out of losing their home. So there's important underlying foundational first principles that are important for us to discuss before you and I start riffing why we think there's a soft landing.
Well, I mean, it does highlight the fact that just even the last 2 years, Bryce, has predominantly been led by owner occupiers in terms of that demand. It's second purchases, it's buying that second property potentially to avoid lockdowns or regional areas. It's taking you into a new era of, basically hybrid work and all of those types of things. So, that'll start to show up in the ABS data that we see coming out in the middle of the year. So we're not too far away from starting to see just how many of those people have those second homes. For me, it is just again about understanding those fundamentals that we've always talked about as well. And that is that we're here for the long term. We're not necessarily just here. So first principle from our point of view is we are long-term hold investors. So, if the idea of buying a property now made sense to you, or the idea of property, let me put that in a better context. If the idea of buying a property when the market was moving healthily was made good sense to you, why does that change now? Like if your fundamentals haven't changed in terms of the income that you're earning, your equity position, and you're thinking 10, 20, 30, 40 years from now, why would you stop executing on that fundamental belief? Like what has changed? I know what has changed, and that is the psychology and the mindset is I want to bargain. So people are going to say, well, I'm just going to wait until it bottoms out. I'm just going to wait till it bottoms out. Now, I'd love to know the count of people around Australia who'd be putting their hands up and say, you know what, I didn't wait till it bottomed out. It never actually did really bottom out. I never saw, it got down by 10% and then it went backward and then it went up again, right? So all of a sudden I was waiting for that. I was told it was going to be 25% crash. So and then all of a sudden now I'm in no man's land where property prices have gone up another 20% and I still haven't been able to execute on that. So we've, from the start of this podcast back in 2015, have said, when is the best time to buy property? It's really simple. First principles are when you can comfortably afford it, and when it's part of your long-term strategy, as part of your investment goals, which basically dovetails into your dovetails, I should say, into your ultimate lifestyle by design story, right? So that to me is just really sensible, boring stuff. Now it's okay to feel a little bit anxious. It's okay to sort of say, well, I'm a little bit uncertain, but go back to, that North Star principle of what you're trying to achieve. And if you're in a position to be able to do something, go ahead and do it.
It's an important point here too, Ben, that we are trying to find properties that will perform well in the third decade, right? Not if we're holding it for the long time, we're trying to find properties for the third decade. So if you are in a position where property is more important story on the cash flow side of things than it is the balance sheet side of things, that's where the skill comes from, being able to ignore some of those price drop estimates, because no one wants to have that negative wealth effect feeling of property losing value on paper. But if you're playing the long game anyway, we've consistently had the message on this podcast that it's about managing cash flow. And if you have got the fundamentals right of asset selection, which are fundamentally important, going forward, you can have that confidence that it's actually easier to buy the properties that you ultimately want to own in an environment where a bit of the heat's taken out of it anyway, than it is when everyone wants to jump on, including the taxi driver, to property when it's hard to buy, it's a hot market. And sometimes what happens in that FOMO environment is people drop their pants on standards on what they want to buy. So I think, again, as a fundamental principle, we don't want to be making 20-year decisions on 6 weeks worth of information. And again, importantly for our community, it's around, okay, if the game here isn't to be a short-term trader, it's to be a long-term investor, it should give us more reason to be comfortable that now isn't the time to panic if you've got the basics right.
So if you're someone who's recently bought and you're thinking, oh no, what have I done? And you've got buyer's remorse, ask yourself a simple question. The asset, how good is it? How rentable is it? How well is it located? What's going to happen to that community? Are we going to see population shrivel? Are we going to see mass exodus of people in that particular location? Or are we going to go through a slow down cycle and then have a reboot cycle? Because if the latter is true, there's nothing wrong with the purchase that you've made. And what Bryce was talking about in terms of that paper story for now, you shouldn't even be worried about it. The only thing you want to be worried about is making sure your tenant's really happy in that property and they're having, sort of quiet enjoyment of that asset and paying the rent, and you're just going on about your merry way. Because what Bryce is referring to is that third decade, the power of compound is what really shows up for you in terms of the passive income that you're going to enjoy in retirement. So I think that's a really good message. For those people who haven't pulled the trigger yet, the reality is going to be for you is why not now? And the question is going to be, if there's different markets within different markets, why would you wait if there are some markets that are going to have growth? So more broadly speaking, we've got to remember CoreLogic's latest data that came out at the end of last month was property prices are still growing in this country. The way in which the media are talking about it, whether they're actually correcting already, that's not necessarily the case. So, what we're going to be talking about in terms of the themes of today around interest rates and around all those other things is just putting some of those things into context, because I think it really is important for our community to understand, have the confidence, and conviction of their belief before, all of this noise started to hit, because we knew it was coming. And that's what we've always said. And we've been going long enough now to be through 2 cycles. So if you go back and listen to, our episodes in 2017, 2018, when the market wasn't performing well, what did we say back then? And then we also, before that time, 2015, 2016, when markets were moving very strongly in New South Wales, and have a listen to how we're talking in those times as well, because this will be a cycle that we will definitely move through. So if you're holding an asset right now and you know that the story is more upside, more opportunity for return as opposed to risk on the downside, you should be putting your money into what you think is going to happen over the longer term rather than the shorter term.
Here's a question for you then, Ben. So are we just prosperity property preachers? Like, is that so? Some people will be thinking, okay.
I have no doubt that there'll be people listening to this going, oh yeah, here they are going into that conservative mode and talking positive about property and Oz property alive. We can't wait for that story again. The reality is, Bryce, is that the risk for a serious correction is very, very low. But if more and more people think that way, then it becomes more and more in terms of becomes, a self-fulfilling prophecy. Right? So what you need to do is you need to have balanced data, balanced messaging around that story. So yes, we might sit on the more positive side, but that's because we've done this for 25 years. And we're saying to those people, it's like, well, here's my portfolio. It's worth X. It generates Y for me. And I've been through 5 cycles over that time, 5 serious cycles, mind you. So I can tell you from someone who's sitting at the top of the mountain, looking down, trying to teach the climbers what you need to be, and that is positive. You don't want to be fearful. You don't want to get nerves. You don't, because you'll stop climbing or you'll turn around and go back down the hill. And so your probability of getting to the mountain and achieving financial peace is going to be restricted. Or by the time you do have the confidence, it can, time is very valuable. The power of compounding over time is also a critical element of this. So that's what we're trying to do. So we are naturally going to be more positive than pessimistic during this period, because we do want to counter the arguments that will come and hopefully go. And then more and more people, as they dig in, you'll basically see this pass, and hopefully it will be that softer landing, generally speaking, and you'll see some markets still performing very, very well in the next sort of 12 to 18 months.
All right, Ben. So one of the reasons why we think that we're just not property preachers, prosperity preachers, is because we've got some underlying foundations that we believe underpin the property story, and we're going to talk about those today. We've got 7, and the first one is we've got a strong economy. We talked about it last week with Evan. We are punching out of our weight division across the globe as a response to the pandemic. We were doing that before anyway, in terms of our population versus the output that we're providing.
Yep.
It's a fact. Our economy is good. Everyone should be happy about that. And if interest rates significantly go north, that is symptomatic of a strong economy, because they're not going to do that at the expense of the economy, given that our homes are protected at the ballot box, because they'll do whatever it takes to protect them. So, Ben, it's a fact. We have a strong economy.
We do. The story around unemployment is the big factor here, Bryce. So it's okay in terms of, if you look at the triangle of doom. The triangle of doom from an economic point of view is high inflation, high interest rates, and high unemployment, right? So where we are right now is we've got a situation where we have very, very low unemployment. And so whilst we are definitely seeing this sort of spike in inflation, and that's naturally resulting in higher interest rates, we've got to remember that those interest rates are coming off a record low. So employment is a critical element of being able to earn income to make those repayments. So we're going to come back to that story around repayments, and we are going to see some wages growth. So even though technically real wages growth, real term wages are lower than what inflation is at the moment, there is wages growth coming through. And we heard the Reserve Governor talk about that in terms of the sampling that he did with businesses. So strong economy means, this is going to be really, really an ace in our pocket. Now, those people who are naysayers are going to say, but Bryce, Ben, we're going to go towards a recession. Like, this is potentially recessionary if we can't get in control of inflation. Now, I'd be saying that is a big statement in terms of whether we're going to go anywhere near that. When you consider the record levels of government spending, you can also look at mining investment, business investment, and general consumption. All of those things bode really well for strong GDP growth. And that's why we're going to see 4% this year and potentially another 2% next year. So, and, again, unemployment getting down to a reading of as low as 3.5%. So immigration comes in, investment starts to come in. We're not seeing that show up in terms of the overall economic data that we're looking at. So we want to keep an eye on business investment. We want to keep an eye on consumer confidence. We want to keep an eye on all of those things. But right now, where it currently sits is things are pretty good in the economy. And so if that momentum continues, then things are going to be pretty good for, our first thesis, which is people are going to be employed, and that means people are going to be able to make those repayments en masse. Remember, we're talking about what's a critical thing here is a mass exodus of people, forced sellers coming into the market, and that's going to be one of the reasons why you're going to hear these people, these commentators, arguing for a crash.
Ben, I think one of the ways to keep the economy strong is a little bit provocative here, is by making sure everyone turns their telly off. If you just don't buy into these stories, that'll help, because you've said it at the top of the show around the real risk here, if we want to put all cards on the table, is that self-fulfilling prophecy of everyone retreating into their shell. So the first reason we think there's a soft landing is we're in a strong economy. The second one is around housing supply, Ben. Now, one of the things that we've always talked about for helping the affordability story is largely about increasing supply.
Yeah.
and that there's not enough supply. And so how that's showing up in the marketplace is still a shortage of accommodation for the people that want it, which which forms a foundation for property prices. Now, I've just said a generalized comment, which we've said doesn't serve everyone. So some markets that won't serve, but in a lot of the built up areas in the high density locations in urban, that is real. I mean, I'm driving to Perth at the end of the year, Ben, to go and see my family finally for Christmas. Hopefully the Australian borders stay open. But and I've got a mate who's going to drive over the Nullarbor with me, and the family's going to fly over, and then we'll drive home together as a family, right? And so he said, yeah, I'll jump in the car and I'll do it with you. On one caveat though, he's building a house right now, around the corner from me. And he says, if that gets delayed any further than what we've got, I probably won't be able to come, to the point where they can't get roof trusses, Ben. So now he's got the chippies. I've seen them this morning when I dropped the kids off to school. They've got a chippy on site who's now building the trusses for the house, just so there's some chance of forward movement. So even if there was an oversupply, you can't get them up quick enough.
That's the reason why supply is going to be constrained, because of basically a skill shortage. So, in the past, supply can come online through mass development, and we did see that through the investor boom of the 2010s. We saw a lot of apartment development and all of that going through, and that's people investing in these off the plan and sort of high-rise apartments, mass medium density stuff. That created definitely a strong building boom. This time around, we saw, obviously, with the government stimulus, that we did see that the builders grants and those types of things. So that has definitely pushed forward demand. But here is the story, Bryce. Demand comes from buyers and renters. So in terms of what we're actually seeing in this new immigration coming in, with that story coming through, we're going to see a challenge of being able to meet the levels of supply that's going to meet the underlying demand as population growth continues on. So I know we're sort of moving between theses here, because that is the demand story, but it also means that, what we're seeing now is a challenge in terms of how we can meet the construction story. I mean, another story we had, Bryce, is a roofer friend of ours. His quotes are only reliable for 7 days. So if his team doesn't start in that 7-day period, the quote is void, because he doesn't even know whether some of his team are going to be poached by another roofer to do that job, because that's how much of a skill shortage there is in there in terms of all the subbies who come on to work with these builders. So it does give you an idea of what's out there. Now, of course,
it helps with the employment story. It helps underlie the employment story that we're talking about, right? Because property is a big employer in this country.
Yeah.
We just did 2 anecdotes there where you just can't get enough people. And in our own business, Ben, we know how challenging it's been to find candidates for the positions that we want to fulfill in our own business, right? So, like, it's not a theory, it's not a headline. It's it's a lived experience around finding it difficult to find talent.
And let's back it up with some data as well as just our anecdote. So, official forecasts by the National Housing Finance Investment Corporation show that housing supply crunch on the horizon, with housing construction set to fall by around 1/3 at the same time our population growth will be normalising, resulting in Australians finding itself 163,400 homes short by demand by 2032. So that just gives you some concept of the medium to longer term levels of demand that we're going to see. So right now, based on their forecast, they're saying that there is enough supply that's in the pipe to meet the demand for the medium term. But what we're saying here is it's not an oversupply. So there is no forced selling. It's just basically supply and demand are roughly in equilibrium. And as of next year, in some cities, they actually start to fall into deficit. So I think that that's an important message to sort of say, where we currently sit from a data point of view on the supply side.
So strong economy, number 1. 2, we've got supply constraints there. Number 3 is immigration. The planes are going to start landing again, Ben. And once they do, they're going to start wanting to put extra demand into, can you imagine what the period would have been like if that we've just experienced over the last couple of years, if that extra demand had existed? Now, that's probably a moot point, because the fact that what we went through was some of the reason why. But
Yep.
When people land here, the forecast for this particular decade was the Roaring 20s. It's now had a little speed hump along the way, but that will resume, and that will further underpin the demand side of property going forward. So that is our third reason why we think that we're going in for a softer landing.
Yeah, and Australia is struggling for skilled workers, right? So we have a program, a fast track program to get skilled workers here in a short period of time. So not only are we going to move back towards that sort of 160,000 positive immigration coming in, we suspect that over the next 2 years, 3 years, that will move back towards its more higher levels. Now, if you're talking about where we got to, in some years there we had, positive net migration of 360,000 people coming into the country. So if we get up to those types of levels, the reason why they're not opening the floodgates is because they know it's terribly inflationary in terms of getting more and more of those people in, but they also know they've got a skilled shortage issue here. So they need to bring the people in for the employment, which takes pressure off wages growth. But they also need to live somewhere, Bryce. So they need shelter. And so ultimately, that's why there will be that really strong level of rent initially. And then as those people get ready to settle in a place more permanently, that will turn into buying demand for those people coming in from a migration point of view, an immigration point of view.
All right, so we've set the scene there with some foundational conversation there. The fourth point for us is the mortgage stress story we don't believe will materialize. And there's a couple of reasons why, but that's speaking directly to the point of the anxiety that is existing right now around interest rates. So there is a record level of savings, 230 billion extra in the marketplace as a result of the fact that people didn't have much money to spend on. So they are well in advance of their mortgage payments. So that buffer naturally exists. And that's for the people, Ben, who actually have a mortgage, because there's a whole bunch of people who don't have a mortgage or have a very low LVR, Ben, because they've actually been in the property ladder for a long time. And the price that they paid is much smaller than the value that exists now. So therefore, the mortgage, if they have one, represents a very small percentage of the value.
What percentage of people have a mortgage in Australia, Bryce?
I think the LVR is about 27%, Ben, according to CoreLogic.
That's the global LVR of debt. But what about the number of people that have a mortgage?
Between 30 and 40%.
Yep. So it's around a third of people. So 2/3 of people own their homes outright or don't have a mortgage, right? So those people are also, they're not impacted by this. And don't forget the pensioners, Bryce, who are sitting back going, finally, I'm going to get some return on my money in the bank, right? Yeah. So, as the term deposits start to actually get to some type of level of, I'm going to be able to also spend that money in the economy as well. So if only a third of people have all this debt, what are they doing? Do they own properties? Well, yes, they do. They own 2 or more now. Well, that's probably going to show up in the data as well. As I said, in terms of the census data, that's what we saw happening because, if you look at go back to the data, look at the percentages of owner-occupied mortgages versus investor mortgages. Investor mortgages were still pretty soft for these last 18 months compared to owner-occupiers. They're improving and they're going up. It's the first home buyers who are coming out of the market, but they were forward demand because they got all of those stimulus incentives on the back of COVID and in terms of those home builder schemes and so forth. So what we're seeing is a bit more of a normalization of the property market. And again, normalization, not crisis, not anything that's going to push us towards a serious contraction in values.
Very good. Now, Ben, you were digging around. We had a bit of conversation. It might be a good spot to talk about some of the data that you found with NAB that can help debunk some of the mortgage stress property retention idea that we're talking to here.
Yeah, so there's a lot of data, and this is data that you can all go and access because you can see these. I looked at both the CBA and also the NAB statements. So they've recently released their financial statements. So it's not hard. It's publicly available information, and you can download their investor PowerPoint pack. Now, we'll put some of these that we're talking about in the show notes so you can see it. But there's a couple of things here. So what the naysayers are talking about is that there's going to be a fixed rate cliff. Oh, cliffs. I just only need to go back in terms of the, the interest only cliff that we were going through, like
JobKeeper cliff.
All of these cliffs that never really materialize into forced selling in concentrated areas en masse, right? So that's what we're trying to talk about here in terms of panic selling, not happening. So in terms of the fixed rate story, we did see that there's going to be, in terms of billions, so this is fixed rate home loans from NAB, and they have about 15% market share. Okay, so you can see here that in 6 months' time to September 2023, that is going to be where you see up until 6 months till September 2022 is 16% of those loans, those fixed loans will expire. In terms of March, 6 months to 2023 will be 17%, and then 6 months to September 23, another 29%. And then it drops off over there. So a lot of people effectively took 2 and 3 year fixed rate loans. Now, what is really important here is the percentage of people. So 30% of customers with repayments on time or less than 1 month ahead. So this is what we talk about in terms of where are the risk exposures in these mortgage books. So we are seeing here that basically NAB is saying 30% of their customer repayments are on time or greater than 1 month ahead, which 67% of which are either investment loans or openless mortgages. So in other words, what that is saying is of that 30% where the customer is only 1 month in terms of their mortgages, 67% of those are investment loans. Now, how do you explain that? Well, it's simple. You do not make advance payments on an investment loan. You usually pay interest only, and you make the minimum repayment if you have a principal place of residence and you have a debt against that, which is non-deductible. So it logically makes sense that in terms of the higher risks of people being able to make those repayments is very low, Bryce.
True, and interestingly, some of the data that they've come through says their LVR down from 44.6% to 37.6% since March 20. So clearly, since the pandemic kicked off, their LVR has dropped, and greater than 90% of customers did have excess borrowing capacity. So they didn't go to their max. So there was built-in buffer for people as well in terms of the amount that they could have had versus the amount that they spent.
And to finish that story off, when you go for a loan, so this is for those people who are building up their knowledge, most people who have had a loan before, understand that the bank doesn't lend you a borrowing amount based on the actual interest rate you pay. They do a concept called an assessment rate or a floor rate. And NAB also in their document says here, all loans originated in the past 2 years assessed on principal and interest basis using a floor rate of at least 4.95.
4.95.
Or a buffer of at least 2.5%. And that is since that time has now moved to a buffer of 3% in November of 2021. So what that's basically saying is, and when we see it in our own mortgage assessments, is that you now have a situation where most loans are being assessed as a minimum of 5.5 or 6% buffer rates. And so all of these loans that were not issued with a 2% servicing rate or an assessment rate. They were issued with a minimum of 4.95. And you can also see that data in CBA's stress testing of their book as well.
So Ben, for context, NAB has 15% market share and Commonwealth Bank has 25% market share. So between the two of them, they have 4 out of every 10 loans, right, of all the markets. So, and this is the feedback. You talked about CBA, you've looked at some data. They're not panicking at all about their books, right? And we've got resilient banking systems that have recourse lending where people AAA rated scores. So people should draw comfort from that, right?
No doubt. And I've even gone in to have a look at their mortgage delinquency rates and their mortgage stress rates. And their approved applicants by borrowing capacity. I mean, here's another example here in terms of first half of 2022, 92% of applicants borrowed less than capacity, all right? And only 8% borrowed at capacity. So 92% had more in the tank if they wanted to borrow more in the last quarter, the last half of the year. So again, all indicators don't point to any severe mortgage stress. But what's going to happen, Bryce, is that there will be data that will come out over the next 6 or 12 months, which will see a small deterioration in this. Because make no mistake, we need to acknowledge that some people probably have pushed themselves a little bit too hard. And there's no mistake that there'll be a small group of people and a small percentage of people who are going to struggle if interest rates go up to, say, 4.5% when they were originally paying 2%. So the banks are already doing something about that in terms of they're getting better and better at their data management, and they'll have proactive conversations with those particular borrowers. But also bear in mind that because this last wave of boom has been owner-occupier led, the question is are they forced sellers? Now they might be forced sellers if they've bought rural properties or whatever they've bought, and they're thinking, well, we don't need to hold that anymore. But I'm not seeing that come up. I'm seeing more of an ability for people to go, I'm going to hold on to this. I want to see it mature. I'm going to enjoy it. And I've got a nice amount of savings, and I've actually done pretty well during the pandemic. And, my
job security is good.
Job security is good. So we're not necessarily seeing that. So the mortgage stress story and the fixed rate cliff, please, I want more data, share more data with me. But what we will do is we'll make sure that, we've got about sort of 10 sample slides that we've taken straight out of those investor packs. And we don't want to take them out of context. Like, we haven't changed anything on them. We just want to show you basically the metrics that they're looking at and what their commentary is. And even Shane from ANZ, their CEO. So Shane was saying recently in his investor update was that, he's very confident that people are going to be able to meet their needs with higher interest rates. And he said, like I just said, was there'll be a small percentage, very small number of people who will have trouble in terms of meeting those commitments, and they'll have a choice to make in terms of what they do. But it's not systemic, and it's not a great risk in terms of mortgage stress.
Top 7 reasons why we think the property crash is unlikely, and we're more likely going to have a softer landing. Number 1 was we're in a strong economy. Number 2 was around housing supply. 3 was the immigration story. 4, we said that we don't believe that mortgage stress story will materialize. Number 5, Ben, is rental undersupply. We had Antonio Mercarella on the podcast only 6 to 10 episodes ago talking about how that is reaching a crisis in Queensland. That is a further underpinning of full use of property within our market. It's in some cases you can't even find rentals.
No, so we've talked about how that works in terms of the overall supply. And, if we see a spike in overall supply, that's put pressure on prices. But in this particular case, why we've raised it here is rental undersupply.
Upwards pressure for investors. Yeah,
it means that you've got your property rented. So your ability to actually make those repayments, if the tenant is covering 40, 50, 60, 70% of the rent, in some cases 100% of the mortgage repayments, like if you think about the loan to value ratio. So all of a sudden, you're not desperate to get a renter into your property. So that, again, will give you some limited risk in terms of seeing clusters of these properties being all dumped onto the market at one point in time.
So number 5, rental on supply. Number 6 is the human behaviour story, Ben. So it's the response. So how are people going to behave? And it's the loss aversion story around. There is the great Australian dream in this country, but there is anecdote after anecdote where people do whatever it takes to batten down the hatches in all other areas in order to make their payments for their house. It is a cultural thing in Australia. So there are examples around the world where that hasn't been the underpinning story, but in Australia, it is a cultural loss aversion story where people will do whatever it takes to fight to keep their asset, which includes looking at all plan B, plan C, plan D, and considering all options. But Ben, the Castle is one of the most iconic movies in this country. I mean, we'll do whatever it takes to protect our castle.
Yeah, that's right. This one is, I mean, I'm a huge fan of behavioral economics and how people operate. So we dig in. Like it's called a loss aversion thing because you will find ways to make it work. And in this particular case, if we had said, all right, well, I can't find a job, I can't find a tenant, I've exhausted all my other opportunities here, I've got to let it go. Well, that's just simply not the case in the current economy. It is, well, I can pick up a second job, I can work weekends, I can do anything else to make sure that I keep that particular property. So from our point of view, why would I be giving up something of such a significant size for the sake of what? Peace of mind. Well, you're not going to get peace of mind if you're making a loss on that. So if you're a recent purchaser, so definitely that loss aversion is going to be a big part of that story. There are other, sort of human behavior stories around on the buying side as well. So, there are, the human behavior of bargains and wanting to be able to find that. So whilst others see pain and misery, the astute investor and the behavior of those people will take advantage of that. There's always positives out of these sort of events. So they'll be waiting on the sidelines or taking action, depending on their current financial position. So there is no doubt from the seller's point of view, loss aversion from the buyer's point of view, you're going to see those people looking for those assets. And the way in which you and I look at that, Bryce, is really simple, is to be able to secure a really, really healthy investment grade property without lots of competition, is a lot easier than not. So we still expect to be under competition where we're buying, and we buy around 50 to 60 properties a month to give you some idea of the number of properties we buy. So,
and most of them, Ben, are not layups without competition.
No, that's right. So we know what's happening in the ground, and we know obviously where price movement is happening in real time, because when you've got that type of tension and analysis from 8 or so buyers agents who are studying that market and analysing, all 200-300 properties a week in those particular areas and what's selling and talking to the agents, we've got live feedback on that. Which we've always talked about how the data is lag data. It's usually property data is 10 to 12 weeks before you get median values of any meaning. When you're out in the field and you're doing that at the sort of volumes that we're doing it at, we can obviously see those types of stories. So that human behavior stuff, we'll talk more to that over the coming months, I suspect, as we explain to people why it's more of a softer cushioning than any sort of fear of anything more severe than that.
All right, so that was number 6, Ben, for the human behavior response. Number 7 is we're looking in the rear vision mirror and having a look at what history can tell us. And history tells us, whilst it's no guarantee, history tells us it's unlikely to occur, and for a couple of reasons. They will use the instrument that we're talking about now to raise rates. They will also use that if needed to on the flip side, but also the property market is protected at the ballot box. It is, imagine trying to win over as the government of the day when your biggest asset that most people have crashed. So therefore, it's too big to fail, and it is underpinned. It is protected at the ballot box, where if anything in history has happened, obviously the GFC saw coming off of values, but it didn't crash.
Yeah.
So look back in history to see if there's any precedent that would suggest that this move will actually be on its own as a standout to cause a crash, because there is no precedent that you can go to, Ben, in recent history to suggest that is likely to happen.
No, the data shows a lot in that, Bryce. And I think the other important point around wealth effect, we've talked about that as another human behavior. When people feel wealthier, and we've never been wealthier as a whole nation. I think it's the IMF actually have us as the richest, sort of nation on earth per capita at the moment. So if we still have confidence about what the future looks like here post-pandemic, and we keep that momentum moving, then the wealth effect obviously turns into consumption. Now, turning interest rates higher naturally means we actually want to turn some of that consumption down to ensure that we don't have demand-led inflation internally, as opposed to the imported inflation that we're currently seeing from offshore. So when we start to think about that, it gives us some context that we actually, the Reserve Governor, by bringing the rates up to a more normal setting, is hoping to just cool the economy a little bit so we can then ease the level of inflation that we currently have. Because that is true. If we have sustained inflation over a longer period of time, that is more of a risk, because that will then start to show up in regards to unemployment. And then we've got ourselves a bit of a difficult story. But we've already know that, with 2% of GDP coming from consumer consumption in this country, it's something that we've got to continue to keep, that fine balancing act going with the RBA, and they'll have no problems at all. Philip Lowe said, if we shoot the mark, we can always, potentially bring it back to find that right balance where we've got, full employment, but we've also got inflation in check. Now that will probably see us going a little above neutral rates, into that sort of cash rate of around 2.5 to maybe 3% by the end of 2023 is what they're talking about. I don't see that happening this side of Christmas for 2022. I see more of a cash rate around 1.5%. But I also, Bryce, wanted to just put some data in behind this story as well, right? So we know through the median data in measuring Australian property value. So again, very blunt, big picture story here, but there's been 5 recessions dating back through the 1970s, and they're severe recessions. The next 5 years after those recessions, we saw that the average price increase was 33%. We had a very, very quick 2-quarter negative recession during COVID. And so that was obviously something that is a technical recession. But we did see what was interesting, and this is why I want to just stress on this one as a finishing point on our thesis is, if you go and have a look at the cash rate chart on the RBA page, you'll see between 2002 and 2008 that we had a long lifting cycle. So that lifting cycle went basically 6 years. Now, over that time, the cash rate, and this is where I want to give it context, Bryce, was 4.25% at the starting point. At the starting point, not 0.35 that we've currently got today. Just feels a bit nervous because it's been 11 and a half years since we've had a cash rate rise. And it moved from 4.25 right through to 7.25, right, over that period. Now, what happened to property prices over that cycle, Bryce? Did they go down?
Mate, they plummeted. They crashed, didn't they? They went through the floor.
Yeah, I'm not sure that came up in my news feed. No, they grew by 50% over that period. Now, that's again the Australian property prices. So people were locking in fixed rates in their 7s. And I'm sort of saying, well, I wouldn't necessarily be doing that. And absolutely wanted peace of mind, and I wouldn't be going too long. But that's unfortunately some people did lock in. Same at the moment in terms of people locking in. They're locking in a premium right now. And so I'm not sure that's the way in which I would go, because, it was a bit like when, the idiots of Russia invaded Ukraine, and we all had that sort of uneasiness about it. And it was just a horrible experience. And now the war is getting on, just like COVID had. You start to get that sort of normalization in your mind. So I'm not saying that's the right thing or not, because we want to keep tension on basically what Russia's doing wrong. But people just, so that initial spike in confidence or deterioration in confidence starts to come back down when everyone goes, you know what, the sun does keep coming up every morning. I do keep going to work. I do see the economy moving okay. I do see people spending all of those savings that they've got, in their buffer accounts. And so I think from that point of view is why you're going to see more of, where's this crash coming? Where's this cliff going to happen? There's no concentration there to have evidence of that severe price reduction anytime soon.
There you go, folks. So what we've covered today is a couple of things, but there's our 7 reasons why we think we're in for a softer landing. So number 1 is a strong economy. Number 2 is around housing supply. Number 3 is the immigration story. Number 4 is we don't think the mortgage stress story will materialize. Number 5 is the rental undersupply that flows onto investor confidence. Number 6 is human behavior response, that loss aversion, fighting to keep their asset. Number 7 is that history in the rear vision mirror doesn't give us any indicators to suggest that it is likely. In fact, it suggests that it's unlikely. So we started the conversation, Ben, around some principles, some first principles for our community to keep in mind around this anxious time. Now we've gone through a bunch of reasons why we think that the crash is unlikely, to help people be the voice of reason within their own communities, within their own friendship circles, within their own colleagues. Now, the third part that we want to talk about today, Ben, is, okay, then who should buy, and is now a good time to buy? Because that is really the next question, right? So, so Ben, if you want to kick it off. So,
I mean, should you buy? Absolutely, you should buy, but just be mindful that what you did at the start of the pandemic, which is the rising tide lifting all ships with record low emergency setting interest rates, meant that you could pretty much pick anything and you've done all right. That is now gone, right? So if you are going to buy now, doing the fundamental analysis, the fundamental research stuff we said, or get professional help during this time is my advice, Bryce. It's like, you know, we have a view in terms of helping people on a long-term journey that is around getting wealthy slow, not getting rich quick. You know, we're still saying make sure that you're really confident in your job security, but also be mindful that there are a record level of job ads out in the marketplace at the moment. So it's not as a big a risk in terms of not finding any gainful employment at the moment. There are businesses out there struggling everywhere to get staff. The risk profile is important for you. So you want to be confident, but confident in the long term. So the fundamentals are, you know, are property prices fundamentally going to continue to keep growing on the back of land scarcity and prosperity in this country? Well, I'm a big believer in that. And finally, Bryce, we always talk about cash flow is king. Don't overstretch yourself. We also said that right through this period of frenetic buying that took place. So we do know that the market will shrink. There's going to be a lot less competition. So we also know that those astute investors who have done well over the last couple of years, you know, if their plan allows them to, or their plan says, get busy buying, I'd like to see them continue on that journey.
But on the risk profile stuff too, it's important for people to really self-assess. If you were someone who is susceptible to anxiety, or you are anxious, it's probably, and you're someone who is influenced by environment, it's probably going to be a challenge for you. You'd probably put that person in the no category if they don't feel they could overcome that, Ben. Yep. Because there is a lot going to come. You know, we said it at the top of the show, there is a lot of negative stories that are going to come. So if your risk profile around your own sense of peace and the way that you can sleep at night suggests that you can't overcome that, you even if your investor profile says, but your mindset profile doesn't, you'd probably sit on the sidelines, is what I would say on that too.
So you're going to park your money in cash. And you're going to have bugger all returns, because
it's not the ideal. Like,
you're not going to put it in equities.
You and I can argue why that's not the right thing to do.
Yeah.
But for your own mental
100%, Bryce. I was playing the devil's advocate there, but that's the shock tactic that I want to say to people. It's like, there's a trade-off here. If you are super conservative, then you need to work on knowledge, because knowledge should build confidence, and confidence to take action, which was Bryce's, you know, mindset minute point at the start of the show, is that you have gainful knowledge and you then execute that, you know, in the basics. You do the basics really well in terms of your research and so forth. Then just sit back, get back on with your life, and check in on your property in 5 years' time and see how you've gone.
Hey, I reckon the commuter belt's going to define itself now. Remember how throughout the last 6 months we've been speculating about where actually is the commuter belt? I think that's going to really be clear in the next 6 to 12 weeks on where that commuter belt actually is, because you'll start to see sales on the outer side of the commuter belt really affect prices, and on the commuter side of the commuter belt, I think that'll hold firm. So that'll be interesting. Hey, the people who shouldn't buy now, Ben, are people who are, and this is a message that's very consistent all the way through. But if you want to get rich quick, you shouldn't be buying now. If you are one of the people that do have job insecurity, you shouldn't be buying now. We talked about the risk profile is negative. You are overly conservative, or you're an anxious person. And then if you do not have cash buffers, now is not the time, because there are going to be more rate rises.
There are definitely going to be more rate rises.
Definitely going to be more rate rises.
And also those people who are thinking about turning apples into apple pie, this is not your time. Let me say that again. This is not your time, because it's really important. If you can't get trades and you're sitting on a half renovated property and things are going to be taking months to get the stove, months to get all of that, you are burning cash. So the pivot here is really clear about buying ready to rent, clean and tidy properties in livable locations. Owner occupier appeal, remember, investment grade, human interest, human behavior needs, looking at the fundamentals and the local economy that you're buying in. And you're probably also going to be saying to yourself, well, am I buying in that really high end of town? Well, it all comes down to how much income you're making. Like if you're making $1 million a year,
knock yourself out.
Dropping 1.5 on an investment property is sort of a drop in the ocean. But
most people aren't.
No, that's right. So we're talking to those people where the sweet spot is in terms of that buying. That'll come down to your cash flows and your incomes, but you're definitely going to see maybe a bit more of an interest in yield. And we're definitely going to see yields and rents starting to improve as well. So that's where you'll see the story play out. So not for everyone, for those people who are risk adverse, who have anxieties around money. In other words, money is still controlling you. Not your time, people. Those people who see opportunity when others see adversity, and that's what we're saying. Not everyone's going to be a property investor over the next 2 years, but those people who are clear on bricks and mortar being their vehicle, and also really comfortable around how they organise themselves in terms of controlling money and putting that money to work and debt management. Another wonderful opportune time is emerging over the course of the next 2 years.
Yeah, very good. Hey, and a little shout out to our clients, because we know a number of our clients listen to this podcast, Ben. We've been preparing you for this moment for the last 15 years.
Long-term cash rates, long-term,
rates and
repayments, 6.5 to 7.25.
Appreciation, conservative buffers, no borrowing against equity for till the third year. So just if you,
vacancy rates of 4 weeks of every year.
4 weeks a year vacant. So so just a little shout out to the Empower Wealth clients listening to this. We've been preparing you for this moment for a long time. So you get to be the voice of reason.
And that is that mindset shift that we talked about last week, Bryce, which is they were just great times. Yeah. And great times don't always last. Yeah. Where you're paying nothing for, you're paying bugger all bugger all repayments. Yeah. They were just great times. So just think of them as great times. Now we're coming back more to more normal times.
Yeah, the tide is going back to its equilibrium. So there you go, folks. Hopefully that's helped you. Back to back, we had Evan last week. This week we wanted to talk to the property story. Send us a little note. Let us know if there's anything that you want to chat about. Go to thepropertycouch.com.au/. Don't / anything. Just go to the homepage. There's a little widget on the side, Speak Pipe. What are your questions that you have right now when it comes to interest rate anxiety?
Bring
what
them.
are they?
And
Send us the questions.
Property crashes, bring them. What is the catalyst? What is the reason this time is different? Please tell us. We would love to know in terms of what you've discovered, what you've been told, because they're the best questions that we can answer, which is the ones who are coming from those concerned, or coming from those naysayers who have been on this bandwagon for 15 years and will eventually hope that they get it right once.
27, they've predicted 27 the last two. And just remember, the economists forget our sixth point a lot, Ben, which is around the human behavior stuff.
Yeah.
That's often forgetting in the economist story. Very good. So there you go, folks. And by the way, if you leave me I say me, Ben, because I control the questions, and then on behalf of you and me, leave a question and we read it out on the podcast. Well, you read it out on the podcast and we record it back. We replay it back. We'll give you a free course. Our Start and Build course. Hey, my life hack today, Ben, is from you, old mate. Hey, a little cheeky chin wag with you, and I would consider you to be a bit of an early adopter on stuff. I love tech and I love getting in amongst it, but I don't know that I would consider myself an early adopter. But you you're ferreting around, you're looking for stuff, you're trying to be in front of the curb and go to your place, you've got Google Home all set up around your joint, and it's like walking through Bill Gates' house at your place, right? So you're ahead of the curve.
Definitely not true, but thank you.
So you've given me this one. I'm probably a bit slow but for those Microsoft users, you can now use their dictation function, and you can hit the little picture of the mic. So new message, and this is all across the Microsoft
Outlook,
suite,
Word, wherever it is. Yep,
across the Microsoft suite, and a whole range of other applications too. But for a lot of people, they use the Microsoft suite. So you click on the little little microphone icon, and then you just start talking, Ben. And so you were saying earlier today that you don't even type your emails much these days.
Fewer emails are being typed, yes. So I try and get my thoughts in order. And as you can see, I'm a rambler. So it's probably training me. It's probably
so you don't type
training
anymore,
me
you just edit.
to be more succinct, because I can't be. So apologies to everyone who's been on this epic long podcast because of my ramblings.
Mate, people draw comfort from what you have to say because you're a voice of reason in the storm. So I think that's really good. So Microsoft dictation in Outlook across the whole suite. Check it out. Give it a go. For those of you that write lots of emails, that might be. I'm going to start doing that a bit over the next couple of weeks, Ben. I thought that was a nice little life hack for you. So I'll adopt it, but I wasn't the early adopter. Some of the people listening to this, Ben, go, "Oh, far out. We've been doing that for some time," and others will be going, "Ooh, might give that a go." So that's my life hack today, mate. What's making property news?
Well, mate, it has been an epic show. So I did have something prepared. I'll just make sure I don't spend too much time on it, because normally I love to, read out the data, right? But here we go. This is the CoreLogic Pain and Gain, our good friends at CoreLogic. This is their December quarter results. National profit-making resales rose 80 to 88.7, up from 87.4 in the September quarter. So gross profits, who says there's no money in property? Gross profits in the quarter, $22.5 billion. Billion dollars, up 20.3% from the $18.7 billion in the September quarter. So that just gives you some idea, Bryce. And I will also just flag one other point in here, which I thought was quite an interesting story here. Houses versus units. So nationally, the high proportion of houses, 91% resold at a profit, relative to 81.9% of units. So that just gives you about 10% more in terms of losses in units. Now, I want to give some context around that, and that was that Darwin really did have some serious losses in the unit market over the quarter. 61.3% of units sold in the Darwin market sold at a loss. So yeah, even the houses market wasn't so great in Darwin. 37% of them sold at a lower price than they were bought for. Now, again, we're going to see a little bit more of this over the course of the next 12 or so months as people may be forced sellers. It's just coming back to our fundamental points. We need to see a cluster, a significant cluster of forced sellers in a particular market to warrant any real systemic risk in terms of the property prices. We are definitely going to start to see B grade and C grade properties come on the market. We are going to see, horse stock as well. But we've got more to talk about this. We've got months to continue to keep talking about this story. Asset selection is important. So that just gives you some idea. So anyway, Pain and Gain, probably one of the best reports you're going to see on the Pain and Gain results for the quarter. So before things start to sort of go back down to, you don't always make profit out of property. So we've always said that too. So you want to make sure asset selection, borrowing power, cash flow management and defense, ABCD of property is all part of your frameworks of investing in property.
Hey, Ben, thanks for swinging past the couch today. That was all valuable stuff. Thanks for sharing what's making property news, mate. But we've got a very special guest next week. I'm excited about that. So stick around, folks, mate. But until then...
knowledge is empowering, Bryce, but only if you act on it.
See you next week, folks.
Hey guys, Bryce here again. Just want to catch you before you go and let you know, if you're new to our community, there are a lot of episodes to catch up on, but it's really important that you start from the very beginning at episode number 1. because episode 1 through to 20 share all of the foundational pillars and frameworks that you need to know to get the best out of listening to this podcast. So I'd recommend that you start there, and the little tip is to maybe start on 1.5 speed. Now, for those of you that are time poor and don't have time to go back from the beginning, don't worry, we've got you covered as well, because we've created a binge guide that goes through all of the details and makes it easy for you to read and get up to speed very, very quickly. So if you go to thepropertycouch.com.au/fast track, you will be able to download that binge guide and you will be up to speed in no time. And whilst you're there, I've got a few extra goodies for you, because we have our top 5 frameworks that you'll learn on this podcast, as well as the Make Money Simple Again ebook, which will help you with the foundations of basic money management, so you'll have everything you need to succeed in building your own lifestyle design and getting the best out of this podcast. Now, just a reminder that anything that we cover on this podcast is not considered financial advice. We certainly recommend that you get your unique circumstances looked at by your individual advisor, and everything we talk about is just general in nature. To thepropertycouch.com.au/fast track, and you can go and get all those goodies and catch up